Hello everyone, welcome to Managerial Accounting. Today we will learn about the cost structure of a company, and we will also learn about different type of cost schedules of a manufacturing company, and all these you will find in chapter 2 of your textbook. So here basically we will learn different type of classifications, how we can classify the costs based on their nature. And before knowing that, we'll try to understand different types of companies. First, let's talk about service company. So these type of companies usually provide service, and they usually don't produce or manufacture any product. Rather, they just provide a service and they don't have any inventory. For example, you can think of a bank, a law firm, and advertising agencies, insurance companies. So usually these type of companies will not produce any product, rather they will just provide service. Now, the second group of company we will learn is a merchandiser. So for these type of companies, they usually purchase products from the suppliers or the manufacturers at a lower cost, and then later they actually sell those products as a higher cost, and this is how they make money. And these type of merchandisers usually have huge amount of inventory. All of those goods that they are buying at a lower cost are their inventories, and then they are selling those goods or products, and this is how they make profit. For example, Walmart, Best Buy, Amazon.com. So all these type of companies, they don't produce any products, rather they buy products and then they sell products. Well, some companies could be a manufacturer and a merchandiser too, but for a pure merchandising company, they usually just buy the inventories at lower cost and sell those at a higher cost. And you will see different type of merchandisers. For example, like wholesalers like BJ's or Costco's versus retailers. Now we will learn about the other type of companies, and that's the most important one because their cost structure is really critical, and we will learn about their cost structure and cost schedules mostly in this chapter. And that type of companies are manufacturers. So, what does a manufacturing company do? They actually produce or make or manufacture products and goods. So in order to do those, they actually purchase the raw materials and then they hire their workers or employees, and they usually have a big factory or it could be a small factory too, and they use all other supporting materials together, all inputs together, and then this is how they convert those raw materials into final product. For example, you can think of Procter and Gamble. They produce so many things like Head and Shoulder shampoo, or you can also imagine like Boeing. They produce all these big aircrafts, and they usually buy those raw materials, or sometimes they can produce some by themselves, and then they have their own labor force, factory employees, and then they produce all those finished products, and then they can sell those to other wholesalers or retailers, that means to a merchandisers, or they could have their own distribution channel. So we will basically emphasize on these manufacturing companies because their cost structure is really critical, because they basically have three types of inventories. So one type of inventory is their raw material inventory. When all those are kind of the scratch level, all those raw materials, when they buy those for the first time, then they bring all the raw materials in their factory, in their production line, and when all those raw materials are under production that they want to produce their final goods, then these are called work in process. So they will have another type of inventory which is kind of under production, and we call those as work in process inventory. And the last type of inventory is their finished goods. That means when they finished their production process and completed their product and goods, those are called as their finished goods, and those are goods that are ready for sale. So a manufacturing company will have three types of inventory. I'm repeating: raw materials, work in process, and finished goods inventory. Now we will see one example. You can think of a car manufacturing company like Toyota or BMW. So you can imagine that these type of manufacturing companies, or if it's a car manufacturer, then they will have three types of inventory. For example, raw materials. So you can imagine how many parts, bolts, nuts, seats, even radios or those windshields, all these inputs are their raw materials. So they will have all this inventory in their warehouse. Then what they do, they actually bring all those raw materials into their factory. This is their production line, and then they hire their employees, all type of labor force, all they are working hard to combine all those raw materials, and this is how they are trying to make their final product. So when these are in the factory line or under production, then we will call this type of inventory as work in process inventory. And when their production process will be done, all those will be converted into finished goods, these beautiful cars. So these finished goods are another type of inventory. So you will see that a manufacturing company will have three types of inventories: raw material inventories, work in process inventories, and finished goods inventory. Now, you will see few definitions and some classifications. So you just need to get some idea about this. First, what do you mean by cost object? So cost object means like anything that managers can kind of separate their cost, their production cost. For example, that car manufacturing company for Toyota, then this car is a cost object. So manager can easily trace out what's the cost of producing these Toyota Corolla 2018 model. Now you can also classify the costs into two types. One is the direct cost. So direct costs are very easily traceable. For example, they can easily identify what will be the cost of these four tires for these Toyota Corolla model. So if you can easily trace out or identify those costs, then you can call those as direct cost. On the other hand, there are several types of costs that are involved in a production process, but it is difficult to identify those. For example, of course, the Toyota company, they pay their utility bills, they pay their property tax, and they have all those huge equipment. They calculate their depreciation expense. But it's really hard to identify what is the utility bill cost to produce one Toyota Corolla model, or how much tax cost we can assign for one specific car. So you see, these type of costs are kind of combined costs, and you really cannot trace it out for per object. So we will call those as indirect costs. Another classification we will learn, which is the product cost, and another is the period cost. And for this chapter, and I would say even for the whole course, you need to know really well these three types of product costs. So these type of product costs actually incur a different production level. And when you have all these costs you are incurring, that means you are adding some value in your production chain. So for your product cost, you will have three types of product cost: direct material, direct labor, and manufacturing overhead. I'm repeating these three types of costs: direct material, direct labor, and manufacturing overhead. And for the whole semester, throughout the semester, we will learn different times and different ways how we can calculate all these costs. And all together will be your product cost. Now, we will see details about all those costs, but there is another classification. We call it like period cost. So of course, these type of costs are valuable, that adds value to your product, and that are required to manufacture a product. But you have to calculate or measure the cost for a specific period of time rather than based on a specific product or finished goods. For example, selling, general and administrative expenses. Those are, of course, your cost of your company, but you will see that these are not directly related to your production. So we will call it, these are period costs. Right, so you of course need to have some other employees, those are not directly related to your production process or are not working in the factory, but you have to pay for these costs. So these are your period costs. On the other hand, remember product cost, that means these three types of costs are directly related to manufacture or to produce a product. Now, again, I circled it because we'll emphasize this one and we really need to know all these three types of costs. Now let's take an example. Since I started with this Toyota car manufacturing company's example, so we will see what could be all these three types of products cost for a car manufacturer. So if you want to produce this beautiful red car, you need to incur these three types of product cost. Number one is the direct material cost. Number two is the direct labor cost. And number three is the manufacturing overhead cost. Oh, there is another definition. It's better to know. These two together, direct material and direct labor, these are known also, these two together are also known as a direct cost. On the other hand, manufacturing overhead is an indirect cost. That's what we saw in a couple of slides before. So these two together is the direct cost and indirect cost. So you know the definition here. So again, to know the product cost, you have to know these three types of cost: direct material, direct labor, and manufacturing overhead. The first two together, you can call it as direct cost, and the last one is an indirect cost. There is another definition. This is called, this direct material cost is also known as the prime cost, and this direct labor and direct and manufacturing overhead, these two together are also known as conversion cost, and we will see all those later very detailed. So now what could be your direct material cost? So I just discussed that to produce a manufacturing car, you need to buy several types of raw materials, right? All these things, nut, bolts, all these raw materials. It could be a seat, a pair of seats, or a radio installed in your car. So the cost related to buy all these raw materials are known as the direct material cost. Some manufacturers, they can produce their own raw materials, but of course they need to buy something right from the scratch, even if like some manufacturer can outsource all of these raw materials and they can just combine and make the product. But a manufacturing company must have this raw material costs. Now, direct labor cost, very simple. All those employees, all those factory workers that are directly related to manufacture the product, and you have to pay their wages, all of your labors, then this cost is known as the direct labor cost. Now you will see, especially for a manufacturing company, of course, you need to hire a huge number of workers, but now we have several like automated systems just because of the advancement of technology. So this labor cost may shrink, but you need to incur in other costs. But definitely for a manufacturing company, you cannot avoid this direct labor cost. So this labor cost is easily traceable. To manufacture a car, you can easily identify how many workers actually involved there, how many hours they worked, and how many dollar you paid for per hour per worker. So it's easily traceable to figure it out the labor cost for a specific product, just like a car. Now, we have third type of product cost, which is manufacturing overhead. So this type of cost is not easily traceable, and this type of cost is also known as indirect cost. And of course these costs are related to your manufacturing process. These are related to your factory or plant, but these you cannot easily trace it. For example, you need to pay the maintenance or the janitors or the security guards fees for your factory, for your plant, but it's really hard to trace it out how much you paid per product. Rather, you usually pay the whole amount either for a specific period or you have certain way to pay it. But remember, these are related to your factory plant, but these type of costs are not directly related to your product. For example, the guy who is cleaning or maintaining your factory floor level, of course, they are important. They are involved in the production process, but not directly to your product. So we learned about three types of product cost: direct material cost, direct labor cost, and manufacturing overhead cost. Now, as I mentioned earlier, direct material and direct labor cost, these two together, you can call it as a prime cost. And if you combine only direct labor and manufacturing overhead, you can call them as conversion cost. Remember, these two are kind of the prime factor if you want to manufacture a product. Without materials, raw materials, you cannot imagine to produce something, and you of course need some labor. On the other hand, these when you have these raw materials, basically this labor force and all of those other overhead related things are helping you to convert those raw material into final product, and that's why this labor cost and manufacturing overhead, these two together, we call it conversion cost. Now you have several other classifications, and you can, it's very simple, self-explanatory. You can just take a look at it. You can also classify some costs as like controllable, uncontrollable costs. So controllable, you can easily control those. Uncontrollable cost, you cannot control those. Management, for example, like the tax rate or some other cost they cannot control. Variable versus fixed costs, you probably have seen it in other courses, especially micro courses, like variable cost, that what you have to pay for like per unit of product, and the total amount of variable cost will increase in volume. On the other hand, fixed cost, this total fixed cost is kind of constant for a specific range of your production level. And then you will also see here this one example here. uh, when like the cell phone, like in 10-15 years back, when this texting options like came first time, then you have to pay for per text. Well, it's now unlimited. You can send like thousand millions text. But now, if you consider this example, and when I had my cell phone like in 10-15 years back, then I had to pay like 50 cents per text. So this is one example of variable cost. That means if I text more, my number of texts are increasing, then my texting cost or bill will also increase. So variable cost is based on your number of unit that you are producing, or and then the more you will producing, the total amount of variable cost will also increase. But remember, per unit variable cost is fixed. The example I gave for per text, the variable cost is 50 cents. So per unit variable cost is fixed, but the total amount of variable cost will increase as the number of your product will increase. Now, that's the example I said. Variable cost per unit is fixed, but the total amount of variable cost will increase as the number of your production volume go up. On the other hand, fixed cost, you will see fixed cost is always constant for a specific range of your production. Say, for example, my phone example, I had to pay one fixed monthly fees, connection fees, no matter if I text or not, no matter how many minutes I talk, but this is kind of fixed. So this total fixed cost is always fixed. But if you think of your per unit of fixed cost, the more you're gonna produce, then the per unit of fixed cost will decline. Because if you have this one constant fixed cost, then if you divide it, your number of production or volume, of course, the higher will be the denominator, the lower will be the result. That means if you produce more, then your per unit fixed cost will decline. Now we will look at different type of cost schedules. And we started our lecture with three types of companies. If you remember, one is the service company, and usually those are you can think of a bank or insurance company. And this type of service company, they have a very simple form of income statement. They don't have any inventory, but when they prepare their income statement, they usually show all of their revenues. They subtract their expenses. This is how they figure out their net income. So for a service company, this looks like pretty straightforward. How about a merchandisers? You remember merchandisers, they purchase uh, the goods or products from other suppliers or from a manufacturing company, and then they sell those at a higher price. And merchandisers should have inventory, but they usually have one type of inventory. It's not like the manufacturing company. We just learned three types of inventories. Now, who can remember what are the three types of inventories of a manufacturing company? Yes, are three types of inventories. One is raw material inventories, another is work in process inventory, another is finished goods inventory. But for a merchandising company, their inventory is only one type, that they purchase from the suppliers or other manufacturing company, and that they plan to sell those at a higher price. And their income statement will look like this. That will start with their sales. Oh, ignore this plus sign, doesn't make sense. Sales, whatever they sell, the sales revenue they generate, then they need to subtract the cost of goods sold. So cost of goods sold means that whatever goods or products you are selling, what's the cost associated to those goods? So you need to subtract those, and we call it gross profit. Try to imagine a merchandiser, either Walmart or Macy's, or even a small mom and pop convenient store in your neighborhood. They buy all those products at a lower price and they sell those to you at a higher price. When they sell those, they are generating sales revenues, and then they will calculate what was the cost when they purchased all those goods, and when they subtract those, they will find their gross profit, or you can also see the term gross margin. Now they need to pay other expenses. For example, they need to pay the utility bill, they may need to pay other uh, other bill, if they other expenses. For example, if they rent a place, they need to pay for those. They need to do some advertising promotion. So all those other expenses, they will subtract here, and they may need to pay all those things, and then they will figure out their operating income. So you see, merchandisers, they have one type of inventory, and the cost related to those goods and inventories that they purchased is known as the cost of goods sold. So if you subtract those from sales, you'll get gross profit. And then if you subtract other expenses, then you will call them as your operating income. Now we will see the next type of company, which is our manufacturing company. And remember, manufacturers, they have the most complicated cost structure, and they need to prepare few cost schedules, and that's what we're going to learn here. So please pay your attention here, because the exercise problems that we are going to do here is related to these manufacturing companies cost schedules, and you also need to do some homeworks. So as I mentioned earlier, that these manufacturing companies, they have to calculate their product cost, which is the goal here. But before that, you need to recall what type of inventories a manufacturing company could have. They have three types of inventories. One is their raw material inventories. Two is their work in process inventory. Three is their finished goods inventory. And then you can also remember three types of product cost. One is their raw material cost or direct material cost. Another is their direct labor cost, and another is their manufacturing overhead cost. So these three types of costs are really important for manufacturing a product, and that's what we call, those are all product costs. Now we will think of those inventories, three types of inventories, and we'll calculate those product costs. So first, let's try to calculate their raw material costs. So it sounds like raw material cost. We need to know what are the raw materials and what's the related cost. So I gave this example. If you want to manufacture a car, it could be like 100 types of raw materials. So what usually companies do, they need to buy those raw materials. Now you can imagine a manufacturing company, they have a big factory warehouse where they could have some leftover or unused raw materials from their previous year, and that's what we call beginning raw material inventory. Because when you prepare any statement, any schedules, you have to follow one specific period or a year, right? It could be your calendar year, or any time you can start it. It could be a fiscal year, and the period could be a monthly, quarterly, or yearly. So whatever is it, so if you start on certain date, certain point of time, you can check and you can see that you have some leftover or some raw materials already in your warehouse from your past period, and we can call those beginning raw material inventory. Then you need to add the purchase price of those new raw material that you purchased in this period. So whatever to manufacture your car, whatever the number of cars you want to manufacture, 50 Toyota Corolla, and then you need to buy all these raw materials. So you have to add the purchase price of all those raw materials. Now sometimes you may need to pay freight or transportation. So if you see there is any freight in means the cost you pay to bring in your product, and freight out means that you pay for selling your product. So freight in, if you have any freight in, you will add those. So now remember, these are the raw materials that you already had, and then you purchased additional raw materials, and these two together we will call it materials available for use. So these are the materials. If you remember from your AC 221 financial accounting course, you had little bit of idea about inventory, first in first out, last in last out. We will not go there, but the concept is same. What you have already plus what you purchased, these are available for your use. And then at the end of the year, you will see that not necessarily you used up all of your raw materials. You may have some leftover again at the end of the year, which we call ending raw material inventory. So if you subtract this ending raw material inventory from material available for use, then we'll call it direct material use. So this is the first chart we need to do, and this is especially for your raw materials or direct materials. So this chart we call it direct material use calculation. So remember, you need to know all these concepts. I'll not provide any chart, or I'll not provide, you will not bring any cheat sheet during the exam. So you need to know all these steps, and you need to level all the numbers. The idea is very simple. You should have some beginning. That means whatever left over from your last period, then you have something new in this year. These two together kind of you have available. Then if you subtract whatever left over at the end of the period, that means the difference is you already used up those. So this is how you can calculate your direct material used. Next, we will see the second part of your cost schedules, and this is related to your work in process inventory. Remember, we have three types of inventories. We just dealt with our raw material inventory. Now we'll think of our work in process. What do you mean by work in process? So if you think of Toyota Corolla's manufacturing plant, close your eyes and try to imagine. They have this huge, big production line. Several people are working here, all those labor workforce, and they are combining all those raw material parts. So that means these are the production line. These are kind of work in process. So now when we are thinking about this schedule, cost of goods manufactured, you have to think of this work in process. So again, the concept is same. When you start a specific period, at that time, you will check what is still in your production line. Those are kind of unfinished product, but those are under production. So on the first day of your year or in a specific period, whatever is already here under production, we will call it beginning work in process. And then throughout the period of the year, you will bring new raw materials, and you also have your labor force working in your factory, and then you have to pay different type of overhead costs, factory or plant related overhead costs. So now these are the three types of product costs that we discussed, and these product costs are directly related to manufacture a product. So now whatever was your beginning working process, you have to add these three types of costs, and this is kind of the maximum cost that you can think of as for your production line for a specific period. So we call it total manufacturing costs to account for. I know it's this wording is, it may sound a little bit difficult to memorize, but if you practice a lot, solve the problem that I have my video, and then do the homework, then you will be able to remember all these things. And I also have one cheat sheet which I distributed you last class. So this one just for your practice, but you cannot bring it during your exam. Rather, you can follow that list to practice your homework. And it's already on your blackboard too. So again, for our second chart, we will start with our beginning inventory, and that's working process. Then whatever new product cost you have, and these are three types of cost: direct material, direct labor, and manufacturing overhead. And these all together, we will call it total manufacturing cost to account for. And then the same concept at the end of the year, we will see what's the inventory that are not yet finished, still as like under production, right? So of course you finished some of your product, you completed few cars, but still you will have at the end of the year some work in process inventory as like under production process in your production line, incomplete. So we will call those as ending work in process. So you have to subtract this ending work in process, and this is how you will figure it out. What is the cost for those products that you manufactured in this period? So conceptually, it's the same. Beginning work in process inventory, then the costs incurred this year, three type of costs: direct material, direct labor, and overhead, and then subtract your one ending work in process. This is how you will get your cost of goods manufactured. Now we will think of our finished goods. So we started with the raw materials, then we brought them into factories. We call those as a work in process. Now, once you've finished your product, you will have your final goods. So in this example, it's a nice, beautiful car. So again, for your finished goods, you may have some cars that you produced last year, but you are not able to sell it. So these are, we will call it as beginning finished goods inventory. Then we're gonna add the cost of goods that you manufactured this year. So try to understand, you already have some cars. These are your beginning finished goods inventory, plus you produced new cars. So these two together, these are the cars, those are available for sale. Now at the end of the year, if you see that you have some unsold car, then the difference, what does it mean? That means those number of cars you already sold. So again, we'll follow the same structure: beginning finished goods inventory. Then we're gonna add our cost of goods manufactured, and then we'll subtract our ending finished goods inventory, and this is how you will get your cost of goods sold. Now remember, up to this we learned three schedules which are really very important. Number one, I can go back. This is our direct material used calculation. Number two, this is our cost of goods manufactured calculation. And this is the third one, cost of goods sold calculation. These three are really important, and these three definitely will be on your exam one. Now, one important thing I want to add, these three parts are connected. How? Let's go back here. When you did your direct material used, this direct material used you are using here. Remember, for the second part, cost of goods manufactured, this direct material used, this green color, we got it from our previous chart, this direct material used. And now after doing this cost of goods manufactured, at the end, you figured out what's the cost related to the goods that you manufactured this year. This cost of goods manufactured, this will be used here in your cost of goods calculation, cost of goods sold calculation chart. And this is how you will get this cost of goods sold. And then you need to do one income statement, which is just like the merchandising company that I have shown it here. Sales revenues minus cost of goods sold minus operating expense. I'm not repeating it because if you check your sheet that I provided you last time, then you could figure it out. Income statement, very simple, but for your income statement, you need to use this cost of goods sold. You need to subtract that from your sales revenue, and this is how we'll get your gross profit, and then you're going to subtract our other operating expense to get your operating income. So basically we will have exercise problems on it, and please watch the exercise problem videos and take notes. Do the same problem with me virtually, because that will be useful for you when you're gonna do the homework. The homework solution is already there, but I'd expect that you will watch the exercise problem videos and then you will try to do it by yourself. If you got stuck, talk to your friend or match with the solution. If you still have any question, maybe next class we'll discuss when we're gonna meet, or you can come to my office hours. So we are almost done with our lecture slides. Please go over the slides again. So this is the inventory concepts. I just discussed beginning. You always have some beginning, then you have some new purchase, these are available, and then if you take out this ending part, this is how you can figure out your cost of goods sold. And in my last slides I put a video, but I don't want to show it to you. Rather, I will request, please download the PowerPoint slides, not the video but the real PowerPoint, and then watch this video. It's a nice video, but it's not the Toyota. I tried to find out the Toyota car production video, but it's Hyundai. We discussed the example of car manufacturing company. So I hope you will enjoy it. Thank you very much for watching the video.